This afternoon, I'm laying out my plan to ensure that the United States will be the crypto capital of the planet and the Bitcoin superpower of the world. And we'll get.
With the IRS closely watching crypto transactions, are you sure you're ready to file your taxes correctly? As the crypto world keeps changing, staying updated on tax rules isn't just a choice. It's a must. From mining rewards to DeFi investments, we'll help you handle every crypto tax situation like a pro. But what happens if you don't report your crypto earnings correctly? Could severe fines be on the way? Keep watching because, in the end, we'll share the essential steps you need to follow to stay compliant. Understanding cryptocurrency taxes made simple. On the other hand, cryptocurrency is digital money that functions differently from regular money, such as the dollar or Philippine peso. Still, there are types, such as Bitcoin and Ethereum. Unlike other platforms owned and operated by the banks or the government, it relies on blockchain technology that is very hard to manipulate while being completely transparent. Now, let's talk taxes. Did you know it's a taxable event every time you sell, trade, or use crypto to buy stuff? The IRS treats crypto as a capital asset, so you need to record its value when you make a transaction. If you hold your crypto for over a year, you might pay less tax since it falls under long-term capital gains. But if you sell it within a year, it's taxed like regular income and the rate can be much higher. Earning crypto from mining or staking, that's also taxable as regular income, and you might need to pay extra if you're self-employed. To stay on top of things, keep clear records of all your transactions, including dates, values, and costs. Tax laws for crypto can change quickly, so it's wise to keep updated and get help from an expert or reliable tax tool. This way, you can enjoy the benefits of cryptocurrency without worrying about tax troubles. What the IRS says about cryptocurrency, in many ways, the IRS looks at cryptocurrency, like Bitcoin and Ethereum, as a type of virtual money, like real money. You can use it to pay for things, keep track of what something costs, or even save it as an investment. But here's the catch. Because its value changes constantly, the IRS sees crypto as something that can bring a gain or a loss, and that's where taxes come in. Whether buying a cup of coffee with crypto, paying for services, or holding onto it as a long-term investment, those changes in value could mean you owe taxes. Jeffrey Joe, the CEO of Fig Loans, sums it up perfectly. Crypto is not just an investment. It's also a handy tool for everyday transactions and saving wealth, which is why the IRS treats it like any other valuable asset. Keeping track of what you're doing with crypto is crucial because taxes can pop up anytime its value shifts. How the IRS treats cryptocurrency taxes. In the US, the IRS doesn't see cryptocurrency, like Bitcoin or Ethereum, as real money. Instead, it calls it property for tax purposes, which means some transactions can be taxed. The tax rates on your crypto earnings can go from 0% to 37%, depending on the type of transactions you've made, how long you've held your crypto, and your total income. There are two central taxes the IRS looks at regarding crypto. First is the capital gains tax, which applies when you sell or trade crypto and make a profit. For example, selling Bitcoin for cash or swapping one type of crypto for another could mean you owe taxes. If you've held your crypto for a year or less, you'll pay short-term capital gains tax, which can be as high as 37%. If you've held it longer than a year, you get a lower rate, between 0% and 20%. And if you're dealing with NFTs, those are taxed a little differently, up to 28%, because they're treated as collectibles. Keeping track of your transactions and how long you've had your crypto is essential for staying on top of your taxes. Paying taxes on cryptocurrency income. Did you know that earning cryptocurrency as income is taxed differently than making profits from selling it? This happens with many crypto transactions, like getting paid in crypto for selling goods or services, earning staking rewards for helping keep the blockchain secure, or mining crypto to create new digital coins. Other ways you earn taxable crypto income include receiving free tokens through airdrops, earning interest by lending your crypto on DeFi platforms, or even getting referral bonuses for introducing others to a platform. Calculating the tax on your crypto income is simple. You take the value of the crypto in dollars on the day you receive it and apply your federal or state income tax rate. So, whether you're mining, staking, or earning rewards, keeping track of the value and reporting it correctly can help you stay on top of your taxes. However, knowing which transactions are taxable and which aren't is key to avoiding any issues with the IRS. Crypto transactions that aren't taxed. Not every move you make with crypto means you owe taxes. For example, buying digital coins with regular money isn't taxable. Moving your crypto between your wallets is tax-free too, as long as there's no sale involved. Sending a small amount of crypto as a gift doesn't trigger taxes or create your NFTs. Donating cryptocurrency is even better. It's usually tax-deductible. But here's the catch. Knowing which transactions are taxable and which aren't is super important to avoid any trouble with the IRS. A financial expert, Stephen Boatman, suggests working with crypto tax pros to stay on track. He says they can help you figure out what you must report so you don't miss anything important. Awareness of these tax-free activities can make handling crypto much less stressful. Crypto tax reporting made simple. If you're dealing with crypto, knowing the IRS tax rules is super important, especially for small business owners and investors. In the US, the tax year runs from January 1st to December 31st, and taxes are due by April 15th. If you're living abroad, you've got until June 15th, and you can request an extension until October 15th with Form 48-68. But remember, an extension only gives you more time to file, not to pay. You must include all the necessary info for crypto taxes when filing your annual tax return. This means having copies of past tax returns, your Social Security number or EIN, and your financial records ready. For crypto disposals, report gains or losses on Form 89-49 and Schedule D. Use Schedule 1 or Schedule C for crypto income. You can file these forms on paper or through tax apps like TurboTax. Staying organized and on time helps you avoid extra fees and makes the whole process much smoother. How to handle crypto taxes easily. Filing your taxes, including those for crypto, doesn't have to be stressful if you follow some simple steps. First, figure out your crypto gains and losses from all your transactions. Use Form 89-49 to list what you've sold or traded. Then, attach this to Form Schedule D on Form 1040. If you've earned income from crypto, report it on Form Schedule 1 on Form 1040 under the Additional Income section. Once all the forms are filled out and ready, complete and submit your tax return. For payment, you can use the Electronic Federal Tax Payment System, EFTPS, IRS Direct Pay, or even mail a check. By following these steps, you can be sure your taxes are done right, avoid penalties, and keep your finances on track. As a result, starting in 2026, brokers will need to track and report the original purchase price of crypto. Significant changes in crypto taxes for 2025. The US Department of the Treasury and IRS have introduced new crypto tax rules for 2025. And here's what you need to know. Crypto brokers must file 1099 forms to report customer sales and profits. Platforms like DeFi and non-hosted wallets are exempt, but separate rules are expected later. Starting in the 2026, brokers must also track and report the original purchase price of crypto. Some smaller transactions, like stablecoin sales under $10,000 and NFT sales under $600, won't be reported. If you use crypto to buy real estate, its fair market value must be reported by 2026. These rules aim to prevent tax evasion, especially among high-income earners. However, there are concerns that miners and developers might struggle since they lack proper reporting tools. A safe harbor rule will allow taxpayers to allocate unused cost bases for wallet assets starting in 2025. Significantly, these new rules don't label tokens as securities or commodities. As Chris Obiluk from Osborne's Law points out, staying updated with these constantly evolving crypto tax rules is key to avoiding trouble and staying compliant. Furthermore, Jarrett Austin, the owner of Bankruptcy Canada, highlights that keeping track of crypto taxes is vital for protecting your business and avoiding fines, why following crypto tax rules is so important. Following the crypto tax rules is essential to avoid big problems, like huge penalties or even your business shutting down. The IRS can track crypto transactions by checking major exchanges, looking at banking info for payments, recording withdrawal addresses, and monitoring custodial wallets. Jarrett Austin, who owns Bankruptcy Canada, points out that staying on top of your crypto taxes isn't just about doing paperwork. It's key to keeping your business safe and avoiding costly fines. He adds that with tools like KYC checks and wallet tracking, the IRS can easily keep tabs on crypto transactions, so businesses need to take crypto taxes seriously. Whether you accept crypto as payment or do things like mining or staking, knowing and paying your taxes is essential to avoid legal trouble. Hiring professionals who handle tax filing is a great idea to ensure everything is done right. This way, you can be sure your tax reporting is correct and follow all the rules. If you found this video helpful, don't forget to hit the like button and subscribe for more tips. Are you ready to tackle your crypto taxes with confidence? Do you feel more prepared to stay compliant with the new rules? Share your thoughts in the comments below. And remember, subscribing ensures you never miss an update on the latest crypto tax changes.